and welcome back. I am Moumita. In this episode, I talk about the important economic and financial indicators which were released last week. There are 6 indicators to discuss today. Let's start. In number 6, China producer prices. The producer prices number came in for the month of February. The number eased in line with expectation. This was helped by the holiday season. February is the Chinese New Year, so many shops were closed and the demand of raw materials was also low. However, on the month-on-month basis, the number showed a rise in the producer prices. There were two components which rose: prices of domestic oil-related industries and non-ferrous metals. The producer prices may not go down as was previously anticipated due to the rising commodity prices. In number 5, China consumer price inflation. The numbers for the month of February remained unchanged from January. On month basis, the numbers were up by 0.6%. This was due to the rise in food prices. There was a rise in the demand of food due to the Spring Festival. The prices of industrial products were also up due to higher prices of gasoline, petrol, and diesel. The government will be trying very hard to ensure the smooth supply of commodities and to make sure that inflation is range bound. However, there can be few negative surprises which may come from the uncertainty of energy prices. Moving to number 4, the ECB Monetary Policy. The European Central Bank met for its monetary policy meeting last week. There are two problems which Europe is currently looking at. One is the increase in prices, two is the slowdown in growth. When there is a rise in inflation and a slowdown in growth, it is called stagflation. The worry is more tilted towards inflation right now. This is because the inflation swaps are showing that there has been a sharp rise in the inflation expectations. The central bank also has revised up its inflation number. Now it expects the annual number to be around 5.1%. Previously, the number was 3.2%. The new forecast is based on the ongoing crisis in Ukraine. To control for inflation, the first step the ECB will be taking is to stop its bond purchase program. It has announced that it will be doing it in the month of July, August, September. That is the third quarter. How will it help if it stops its bond purchase program? When the central bank purchases bond, it infuses more liquidity into the economy. This leads to higher inflation. So when the central bank will stop buying more bonds, it will at least lead to stopping of additional rise in inflation. As of now, out of the ECB members, 15 of them are hawkish, 10 remain dovish. In number 3, US sentiments. The University of Michigan sentiments came out for the month of March and it has worsened in line with expectations. The numbers are now at an 11-year low. The ongoing crisis in Ukraine has weighed heavily on the sentiments. The people expect inflation to be a big concern in the near term. The one-year inflation expectations jumped in the month of February. This has led to a worsening of the future sentiments. One thing needs to be noted: even though the sentiments are poor, the job market data is showing that the economy is improving and lot of jobs is being created. In number 2, US CPI. The inflation numbers continue to surge. The February number touched a high of 7.9%. The rising food rent were the biggest contributors. There was also a rise in the gas prices. It should be noted here that the war in Ukraine had started only towards the end of February. So the 7.9% number only reflects partially the impact of higher commodity prices. The March numbers will be much higher. However, the central bank does expect that inflation to come down in the medium term. Two reasons why it feels so. Firstly, it is getting a support of a high base, which would help the numbers ease. Secondly, there is little bit of resolution in the supply chain issues. There is an indicator called the New York Supply Chain Index, which is showing that the pressure on the supply side logistics have eased in 2022, although the number is still very high. Within the CPI data, there is some positive news which is coming from the automobile prices. The vehicle costs are showing some signs of easing. The used car and truck prices fell in the month of February. This is a significant component of the US CPI basket. And finally, number one, India industrial production. The industrial production growth number for January was released last week. The number continued to remain low. In January, there was a sharp rise in COVID 19 cases and there was restriction in mobility. So, this number was bound to be low. However, the industrial production growth number has not only been low for January but the previous 3-4 months as well, which is a sign of worry. Demand may not be picking up as it was initially anticipated. The growth in the consumer durables goods also continue to remain low. There is no meaningful improvement. The rise in the commodity prices may lead to slowdown of the consumption goods further going ahead. The good news is that there is some traction which was seen in the manufacturing sector in the month of January. Overall, the biggest crisis for all the economies right now is surging crude and commodity prices. It is likely to lead to rising inflation of almost all the economies and also lead to slowdown in growth of all the economies. That is all for now. I am Moumita. Thank you for listening. Bye bye.